What are the best businesses to be in if you're aiming to create the most business wealth? That's a broad question, and it depends a lot on historic context. If you're considering the Gilded Age, which is a term that Mark Twain coined for the enormous personal fortunes created from just after the Civil War to the turn of the 20th century, railroads, steel, oil, and finance might have come to mind, with names like Vanderbilt, Carnegie, Rockefeller, Morgan amongst the many beneficiaries of the Second Industrial Revolution. 100 years later, and most of us have been living through the Third Industrial Revolution, this time digital in nature. Forbes released its first Forbes 400 list of richest Americans in 1982. At that time, you could make the list with $100 million in net worth, which would be something over $300 million 40 years later. And after 40 years, just 17 members of the first list were still on that list, which gives you a small taste of the vibrant times in which we're fortunate to live. At the end of 2024, it took a personal fortune of $3.3 billion to be included in this exclusive club. All the members of this list, like most multimillionaires, got there by being business rich. And which business sectors were the most prominent? Financial services and investments boasted about 110 members of the group, with many engaged in managing money from private equity to venture capital to distressed debt to hedge funds. Most of the companies in this space were non-existent when I graduated from college, yet today there are over 10,000 asset management firms. In second place, technology firms, with about 70 members, but with the highest representation at the top of the overall list. What makes investment management and technology companies so highly represented in today's Forbes 400 list? The open secret lies in the business model. First, these companies address large markets for their services, meaning they've all grown to be very big businesses. Second, the underlying economics tend to create the groundwork for strong business models capable of delivering high rates of current shareholder returns, or current cash flow available to shareholders as a percentage of equity creation cost. And that is what I designed the value equation to compute. Invariably, the finest business models generate the highest current pre-tax unlevered yields on equity. Of course, most companies take on borrowings or leases, which I collectively call OPM, or other people's money. But if you ignore this and assume that business investment is funded with just equity only, the best businesses tend to deliver the highest current rates of return. The formula for that involves just 4 of the value equation's 6 variables and would look something like this. You would just take your sales times your operating profit margin minus your maintenance CapEx and divide all that by business investment. But if you've been following the value equation channel, that is not really how I like to show the formula. I prefer to break it down into its components as follows. Sales divided by business investment times operating profit margin minus maintenance CapEx divided by business investment. I prefer this approach because we can start to look at businesses more abstractly without the need for numbers at all. It starts with a sales to business investment ratio, which is simply the number of dollars in sales for each required dollar in business investment. The higher the ratio, the more efficient you are. Then you multiply that by the operating profit margin. And again, the higher the operating profit margin, the better. The second step is to subtract average annual maintenance capital expenditures as a percentage of business investment. Recall our hot restaurant concept from an earlier episode with the following value equation variables. You start with $5 million in annual sales. Next is there's a $3 million business investment cost. Third, there's an operating profit margin of 20% of sales. Fourth, there's OPM funding of $2.25 million, which is 75% of business investment, and $750,000 in equity, which is 25% of business investment. There's a cost of OPM amounting to 8% annually, and there's $150,000 in maintenance CapEx cost, which is about 5% of business investment. The unlevered current pre-tax return for shareholders on creation cost becomes this. 5 million divided by 3 million times 0.2 minus 150,000 divided into $3 million is going to equal 0.2833 or 28.33%. That's your unlevered rate of return, your current unlevered rate of return. And the first 2 variables equal a sales to investment ratio of 1.67 or $1.67 in sales for each dollar made in business investment. So then you could take the equation and do this. $1.67 times 0.2 minus 0.05 equals 0.2833 or 28.33%. We're starting to see that the value equation could be a relationship-based equation rather than simply using actual numbers. And the same goes for using 0.05 or 5% for the annual maintenance CapEx as a percentage of business investment. But the world's best business models do more than just have the best unlevered current rates of return. They tend to share three attributes. The first of these is operating leverage. The very best business models tend to have what's called operating leverage, or the ability to grow sales without a meaningful addition to business investment. Technology companies can really exemplify this because once software has been designed and paid for, companies can produce lots of copies without needing added business investment. Investment companies can likewise add revenues without much in the way of added business investment. Once they've rented or bought their office space and invested in their corporate infrastructure, they can add investment clients and manage added portfolios with little in the way of added business investment. And our restaurant company, it's less good. To materially raise revenues, I need to have a second restaurant because the first location has a limited ability to elevate its sales. So let's turn to the second attribute of really great business models. The very best business models tend to have economies of scale. That's the ability to grow revenues with limited commensurate growth in expenditures. So operating profit margins tend to get better and better at higher sales levels. Again, technology companies tend to look great here, which is why there are so many represented in the Forbes 400 list of wealthiest Americans. Added software can be delivered, or more internet searches provided, or more videos streamed with little in the way of incremental operating costs. The margins just get better. With investment management firms, the economies of scale are likewise attractive, if not quite as much. As added investments are made and added customers are obtained, staffing needs to increase, but the added incremental staffing cost involves more junior employees, which means that the company can achieve higher profitability because it does not need to proportionally add the same level of expensive senior talent. In our restaurant, for sure, there are economies of scale in a restaurant. Once you've covered your fixed costs, operating profit margins will rise. But at some point, profitability does not get much better. There are just too many variable costs. Technology and investment management companies tend to look good by measures of operating leverage and economies of scale, but also note that these businesses share a third characteristic. They are predominantly service enterprises in appearance and are much more asset light than manufacturing companies. So their business investment entails less in the way of a commitment to a manufacturing facility. They don't require much or anything in the way of inventory investments, and they often have rapid cash flow cycles with little in the way of investments in accounts receivable. Investment management firms take their fees off the top of the funds they manage, and technology companies often receive their payments quickly through subscription-based services. And as we know from an earlier episode, greater asset efficiency means there is less business investment that needs to be funded with OPM and equity. And less equity, all things equal, means higher equity returns and an increased chance of business wealth creation and becoming business rich. So this gives you an idea about some characteristics that the very best businesses commonly share. Most multimillionaires made their money by being business rich, and most of the companies they ran did not have the impressive business model characteristics shared by technology and investment firms. The most recent company I created had little in the way of operating leverage or economies of scale. And being a real estate company, we sure weren't asset light. But we delivered solid equity returns and had an equity valuation multiplier of around 1.4 times by the time I departed. The idea is to do the best with the business model resources you have. And that, together with stock ownership, enabled me to save more money than I could have ever done otherwise. Like most multimillionaires in America, I became business rich. I'm Chris Volk. You can find me at christopherhvolk.com. And thank you for joining me on this business wealth creation journey.